What is CPI? The Consumer Price Index (CPI) measures how the price of a basket of goods and services bought by a typical household changes over time. Think of the basket like a grocery list you always purchase: bread, milk, gasoline, medical care, etc. Formula: CPI sub T equals cost of basket in period T divided by cost of basket in base period times 100. The base period is usually set to 100. So a CPI of 120 means the basket costs 20% more than in the base period. Step-by-step computation, numerical example. 1. Choose a base year, say 2020, CPI equals 100. 2. Define the basket, 10 loaves of bread, 5 gallons of gasoline, 2 doctor visits. 3. Collect prices. 2020, bread $2, gas $3, doctor $50 gives basket cost equals 10 times 2 plus 5 times 3 plus 2 times 50 equals $20 plus $15 plus $100 equals $135. 2023, bread $2.5, gas $4, doctor $55 gives basket cost equals 10 times 2.5 plus 5 times 4 plus 2 times 55 equals $25 plus $20 plus $110 equals $155. 4. Compute CPI. CPI sub 2023 equals 155 divided by 135 times 100 equals 1.148 times 100 equals 114.8. So by 2023, the basket is about 15% more expensive than in 2020. 5. Interpretation. Annual inflation rate can be approximated by the change in CPI. 114.8 minus 100 divided by 100 equals 14.8%. Over 3 years, or roughly 4.7% per year. This method is what statistical agencies use, except the actual basket contains hundreds of items and weightings based on household spending surveys. CPI is a powerful number, but it can be biased because the real world does not stay still. Substitution bias. When the price of one good rises, consumers often switch to a cheaper alternative, for example buying chicken instead of beef. The fixed basket CPI assumes they keep buying the same amount of beef, overstating the cost of living. Adjustment. Use a geometric mean or chain CPI that updates quantities each period. Quality bias. Products improve over time, faster computers, safer cars. If we simply track the higher price, we attribute the entire increase to inflation, ignoring the added value. Adjustment. Hedonic regression isolates the price change due to quality attributes and subtracts it. New product bias. New goods, smartphones, streaming services appear after the base year, so early CPI estimates miss them. Because newcomers are often cheaper or provide more utility, the CPI initially overstates inflation. Adjustment. Regularly revise the basket and incorporate new items. Outlet bias. Shopping habits shift from department stores to discount clubs or online platforms where prices are lower. A basket that only watches traditional outlets will overstate price growth. Adjustment. Survey a wider range of outlets and weight them according to consumer expenditure patterns. By applying these techniques, statistical agencies produce a CPI that is closer to the actual cost of living changes experienced by households. The Consumer Price Index lets us turn nominal money-denominated numbers into real terms that reflect purchasing power. General conversion. Real value equals nominal value divided by CPI over 100. The divisor CPI over 100 is the price index expressed as a factor. For example, CPI 120 becomes 1.20. Real wages. If a worker earned $50,000 in 2023 and CPI is 130 with base 2015 equal 100, the $2015 wage is real wage. 2015 equals 50,000 divided by 1.30 equals $38,461. This shows the worker's purchasing power relative to the base year. Real interest rate Fisher equation. Real rate equals nominal interest minus pi. Pi equals CPI at time t minus CPI at time t minus 1 divided by CPI at time t minus 1. If a bank offers 6% nominal interest and CPI rose 2% last year, the real return is about 4%. Real gross domestic product. National accounts report nominal gross domestic product current price output. To obtain real gross domestic product constant price output, real GDP at time t equals nominal GDP at time t divided by GDP deflator at time t over 100. Although the GDP deflator differs from the consumer price index, the same idea applies: divide by the price index to strip out inflation. These conversions are crucial for managers. They let you compare costs, revenues, and wages across years on an apples-to-apples basis. Example: a firm's revenue grew from $10 million with CPI 110 to $12 million with CPI 121. Nominal growth is 20%, but real growth is 12 divided by 1.21 divided by 10 divided by 1.10 equals 9.917 over 9.091 equals 1.091 or 9.1%. Only about half the nominal increase is due to higher output, the rest is inflation. Inflation is not a single thing, it can arise from different forces. CPI trends help us spot the dominant cause. Number 1. Demand pull inflation, too much money chasing too few goods. When aggregate demand outpaces supply, prices rise across the board. In CPI data, you see a broad-based, relatively steady upward trend in most categories: food, services, housing. Example: rapid GDP growth, low unemployment, and rising consumer confidence often precede demand pull inflation. Number 2. Cost push inflation, higher production costs push prices up. A supply-side shock, oil price spike, wage hikes, supply chain disruption raises the cost of inputs. CPI shows higher increases in energy and commodities first, then pass through to other items. A sharp temporary jump in the energy component, followed by secondary rises in transportation and food, hints at cost push. Number 3. Built-in or wage price spiral inflation. Expectations become entrenched. Workers demand higher wages to keep up with past inflation. Firms raise prices to cover higher wages, and the loop continues. CPI data reveal a sticky pattern. Even when demand weakens, inflation stays near the previous rate because of built-in expectations. A persistent gap between actual inflation and the central bank target may indicate built-in inflation. Identifying with CPI. Plot the overall CPI and its major sub-indices. Look for a uniform rise, demand pull. Look for a spike in specific sectors, energy, raw materials, before the general rise, cost push. Look for stable, moderate inflation despite weak demand, built-in expectations. Understanding the cause guides policy. Demand pull calls for tightening monetary policy. Cost push may need supply-side measures. Built-in may need anchoring expectations through credible inflation targets. Explanation. The Phillips curve depicts an inverse relationship between inflation, pi, and unemployment. It originated from the observation that years with low unemployment tended to have higher wage inflation. Basic form: static. Pi sub t equals pi superscript e sub t minus beta u sub t minus u star. Pi superscript e sub t equals expected inflation. U star equals natural rate of unemployment, NAIRU. Beta greater than 0 measures how sensitive inflation is to the unemployment gap. When expectations are rational, people correctly anticipate inflation. We use the expectations augmented Phillips curve. Pi sub t equals pi sub t minus 1 plus lambda u star minus u sub t plus epsilon sub t. Here lambda captures the speed of adjustment. If unemployment falls below u star, inflation rises. Quantitative example. Assume u star equals 5%, beta equals 0.5. Expected inflation pi superscript e equals 2%. If actual unemployment is 3%, pi equals 2 minus 0.53 minus 5 equals 2 plus 1 equals 3%. If unemployment rises to 7%, pi equals 2 minus 0.5, 7 minus 5 equals 2 minus 1 equals 1%. Thus, a 2 percentage point rise in unemployment lowers inflation by 1 percentage point. Policy implication. A central bank can try to move unemployment below the natural rate to temporarily boost inflation, but the trade-off fades as expectations adjust, shifting the curve upward, the accelerating inflation problem. This relationship is the backbone of many monetary policy rules. Empirical work often estimates beta using regression of CPI-derived inflation on the unemployment gap, controlling for lagged inflation to capture expectations. The coefficient tells managers how sensitive price levels are to labor market slack. Labor market metrics are built from three raw counts. Employed, E, people working for pay or profit. Unemployed, U, people without a job, actively looking and available to work. Not in labor force, and retirees, students, discouraged workers, etc. The working age population, P, equals E plus U plus N. 1. Unemployment rate, equals U divided by E plus U times 100. 2. Labor force participation rate, LFPR. LFPR equals E plus U divided by pay times 100. 3. Underemployment, U6 measure, includes discouraged workers and part-timers who want full-time work. U6 equals U plus part-time involuntary plus discouraged divided by P times 100. Illustrative data set. Category employed 150 million, unemployed 10 million, discouraged 2 million, part-time involuntary 5 million, not in labor force 230 million, working age population P 397 million. Calculations. Unemployment rate equals 10 divided by 150 plus 10 times 100 equals 6.25%. Labor force participation rate equals 150 plus 10 divided by 397 times 100 approximately 40.3%. U6 equals 10 plus 5 plus 2 divided by 397 times 100 approximately 4.28%. These numbers help managers gauge the pool of potential workers, wage pressure risk, and consumer spending power. A falling labor force participation rate can signal demographic aging or discouraged workers, both of which affect long-term demand. Key point for exams: always start with the raw counts, then apply the formulas. Do not confuse the denominator of unemployment rate, labor force, with that of labor force participation rate, working age population. Unemployment can be sliced into three causes, each leaving a different imprint on CPI and output. Frictional short-run mismatches, new graduates, job switchers. It is normal and does not depress overall output much. CPI impact is minimal because aggregate demand is unchanged. Structural mismatch between workers' skills and the evolving technology or geographic distribution. This often shows up as sector-specific CPI divergences. For example, high CPI in high-tech services while manufacturing CPI stays flat, reflecting wage pressure in growing sectors. Cyclical result of insufficient aggregate demand. When the economy falls into a recession, output gaps widen and CPI may flatten or even fall, deflationary pressure. The unemployment rise is primarily cyclical. Macro impact assessments. Compute the output gap. Y gap equals open parenthesis Y actual minus Y potential close parenthesis divided by Y potential. If Y gap less than 0, negative cyclical unemployment dominates, and CPI trends will show subdued growth. Sector-wise CPI can pinpoint structural issues. A persistent rise in the healthcare CPI, while overall CPI is stable, may indicate structural wage pressures in that sector. Example, suppose the manufacturing sector CPI rises 6%, while services rise only 2%, and overall CPI is 3%. A large manufacturing-specific increase could signal structural bottlenecks, skill shortage, prompting targeted training programs. Understanding the composition of unemployment helps policymakers decide whether to use demand stimulus, cyclical, raise skilling, structural, or simply accept the natural frictional turnover. Natural rate of unemployment, NRU, often called NAIRU, non-accelerating inflation rate of unemployment, is the unemployment level consistent with stable inflation, pi dot equals 0. It is not directly observed but estimated. Estimation techniques. Structural Phillips curve regression, regress inflation on the unemployment gap and lagged inflation. The gap that makes the intercept 0 is the NAIRU. Kalman filter / state space models. Treat NAIRU as an unobserved state variable that evolves slowly and estimate it together with the Phillips curve parameters. Hodrick-Prescott HP filter. Decompose the unemployment series into trend, NRU, and cyclical components. Sample calculation using a simple regression. Assume we estimate pi sub t equals 0.5 plus 0.8 u sub t minus u star. We have observed average inflation pi bar equals 2%. Set pi sub t equals pi star equals 2% and solve for u star. 2 equals 0.5 plus 0.8 U star minus U star. This trivial example shows the intercept represents the inflation when unemployment equals NAIRU. In practice, you estimate U star by finding the unemployment level where the residuals of the regression have zero mean. Policy implications. If actual unemployment less than NAIRU, upward pressure on inflation, the central bank may raise rates. If actual unemployment greater than NAIRU, slack in the labor market, rates may be cut. ME's estimating NAIRU can lead to policy errors. Tightening too early can cause unnecessary recession, while staying too loose fuels inflation. Quick numeric illustration. Suppose the estimated NAIRU equals 5.2%. Current unemployment equals 4.0%, gap equals negative 1.2%. Using beta equals 0.5 in the Phillips curve, expected inflation rise equals 0.5 times 1.2 equals 0.6 percentage points above target. The central bank may respond by increasing the policy rate by roughly 0.5 to 0.75 percentage points to offset the inflationary pressure. For MBA exams, remember the steps. I choose estimation method, Roman 2 compute the gap, Roman 3 translate the gap into expected inflation, Roman 4 discuss policy response. Inflation targeting is a framework where the central bank publicly announces a desired inflation rate, for example 2%, and steers policy to achieve it. The Taylor rule provides a systematic way to set the short-term nominal interest rate I sub t equals r star plus pi sub t plus alpha pi times pi sub t minus pi star plus alpha y times y sub t minus y star. R star equals equilibrium real rate, often 2%. Pi star equals inflation target. Y sub t minus y star equals output gap percent deviation of real GDP from potential. Typical coefficients alpha pi equals 0.5, alpha y equals 0.5. Numerical simulation assume r star equals 2%, pi star equals 2% period 1 CPI indicates pi equals 3%, output gap equals minus 1% recession period Taylor rule rate I equals 2 plus 3 plus 0.5 times 3 minus 2 plus 0.5 times minus 1 equals 5 plus 0.5 minus 0.5 equals 5%. Outcome: a 5% policy rate is relatively tight, which may dampen inflation, but could deepen the recession. The rule can be modified, for example lower alpha pi to allow more stimulus. Simulation over 2 periods. Period 1 inflation 3% output gap, minus 1% policy rate 5%. Period 2 after policy inflation 2.5% output gap, minus 0.5% policy rate 4.75%. The rule gradually lowers rates as inflation converges to target and the economy improves. Linked to unemployment, the output gap correlates with the unemployment gap via Okun's law. A negative output gap leads to higher unemployment, leads to lower inflation pressure. Thus, the Taylor rule indirectly balances CPI-derived inflation and the unemployment rate. For an MBA case study, you can show how tweaking alpha pi or alpha y changes the trajectory of CPI and unemployment, illustrating the trade-off central banks face. Explanation: below are typical exam-style questions and a template you can adapt for solving them. Each question ties CPI-derived inflation to labor market outcomes. Question 1. Compute the CPI inflation rate, real wage growth, and interpret the unemployment inflation trade-off. Given base year basket cost $200, current year basket cost $240, nominal wage $55,000, CPI base equals 100. Step 1. CPI equals 240 divided by 200 times 100 equals 120. Step 2. Inflation equals open parenthesis 120 minus 100 close parenthesis divided by 100 equals 20%. Step 3. Real wage equals 55,000 divided by 120 over 100 equals $45,833. Step 4. If unemployment fell from 6% to 4%, using pi equals expected pi minus 0.5 times open parenthesis u minus u star close parenthesis with u star equals 5% and expected pi equals 2%. Compute expected inflation equals 2 minus 0.5 times open parenthesis, 4 minus 5 close parenthesis, equals 2 plus 0.5 equals 2.5%. Step 5. Discuss whether the 20% CPI rise is consistent with the Phillips curve prediction. It is not, which suggests a supply-side shock. Question 2. Estimate the NAIRU using a simple regression. Data for 4 quarters. Inflation 2.0, 2.2, 1.8, 2.1%. Unemployment 5.5, 5.2, 5.8, 5.4%. Regression pi equals a plus b times u. Solution: compute ordinary least squares. Suppose a equals 0.5, b equals 0.3. NAIRU: set pi equal to pi star equals 2%. Solve 2 equals 0.5 plus 0.3 u, which gives u equals 5%. Interpretation: if actual unemployment falls to 4%, inflation pressure approximately equals 0.5 plus 0.3 times 4, which is 1.7% below target, so the central bank may cut rates. Template for any CPI unemployment problem. Step 1. Identify data: CPI values, price index, nominal variables, unemployment counts. Step 2. Compute CPI if not given, which gives the inflation rate. Step 3. Convert nominal to real using real equals nominal divided by open parenthesis CPI over 100 close parenthesis. Step 4. Apply Phillips curve formula appropriate for the question, static or expectations augmented. Step 5. Calculate gaps: unemployment gap U minus U star or output gap. Step 6. Derive implied inflation or required policy rate, Taylor rule if asked. Step 7. Interpret: does the result suggest demand pull, cost push, or built-in inflation? What policy response is advisable? Tip for essays: start with a short definition of CPI, then move to the mathematical steps